The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
A very warm welcome to this Monday edition of Squawk Box. I'm Steve Sedgwick. We've got Karen Cho and Arabile Gamede, and these are your headlines. Well, the news out of China is that the economy appears to be faltering, extending a slowdown in industrial activity and real estate prices as pressure grows on authorities to ramp up spending and stimulate demand. The countdown is on. Finally, we're going to get a result on this one. The S&P and Nasdaq closing out their best week of 2024 ahead of a crucial test markets with rising bets, actually extraordinary, that the Fed could deliver a 50 basis point cut this week.
India can sustain growth of up to 8%, according to the Reserve Bank governor. But he tells CNBC exclusively there are still headwinds for rates and inflation.
It's not so much how the inflation is now. We have to look at for the next 6 months, for the next 1 year, what is the outlook on inflation.
Republican nominee Donald Trump is safe after what the FBI is describing as attempted assassination. It's just 50 days until Americans go to the polls.
Good morning. How are you?
Very well, thank you.
I am so excited.
Yes.
Not only to be back working with you after your incredibly busy weekend, but I just finally, our viewers will be relieved that finally we're going to get the Fed decision. But I think it's extraordinary. I have never known a rate decision like this where the market is so split on 25 or 50. And a full apologies to those of you out there. And I know there are many of you out there who don't care. You've had enough of it. You know it's going to be a cut. It's going to be a dovish cut if it's 25, or it's going to be a statement of intent when it's 50. But the signaling historically from the Federal Reserve is we do not want to upset the apple cart. And I'm going straight to the markets here. They do not want an outsized exponential reaction from the markets. For everybody to be going into this decision a day or so away, not knowing if it's 25 or 50. I find that in itself quite extraordinary.
It is a make or break week in a sense for Jay Powell, and there's been a lot of writing already in terms of whether he can now achieve a Greenspan-like landing for the US economy. And it's just extraordinary because it wasn't so long ago we're talking about the Volcker-like characteristics that Powell was having to display to fight inflation. Now the question is whether he can land this thing and whether he can take on Greenspan, and the FT likened it today to the Hall of Fame, whether he'll go into that Hall of Fame for executing on monetary policy. I think it's just extraordinary how much now rests on his shoulders in terms of getting this right, all at a time where you've got so much geopolitics playing out. And of course, the US election, we're watching the events again over the weekend, whether there is going to be any impact on the US election if we go into this rate cutting cycle right on the eve of an election.
I think you make a very good point as well. And look, the enormous events surrounding Donald Trump of the last 24 hours, we'll come to that later on as well. There's not a huge amount we can add to the facts on that one. But what is absolutely cool, there's no violence it has any place in any democracy as well. But the other point is, just going back to the former president, he possibly will be railing against Jay Powell again with a 50 basis points. And you make absolutely the right point there as well, because, of course, it's very, very tricky for central banks in the run-up to any election as well, but especially in the United States as well. And historically, they try and stand pat around the election if they can. But of course, they have to start the rate cutting cycle at some stage. How's Trump going to react if there is indeed 50 points?
The irony is that it does take a while for a rate cut to come through the system, maybe even 6 months plus. So if there'd been a rate cut earlier in the year, it might have had more distance with the US election, but it might have had more impact. Now we're on the cusp, and any cut now you think wouldn't have much of a ramification, but the optics would be quite interesting in terms of the election.
Yeah, and we're going to take a look at how the markets are performing on this one as well. But again, markets are beautifully behaved, despite the couple of wobbles we've seen over the last 5 weeks as well. In terms of what we're expecting, Yes, 25 or 50 is stunningly interesting, but we get a dot plot and we get a Powell statement and press conference as well. So it's not just about the decision itself, it's the optics around it as well. But Karen, as I mentioned, the markets looked beautifully behaved last week.
I mean, what a week in terms of the rate gains or the gains we saw across on the markets thanks to expectations around rates and also the repositioning around whether it's going to be 25 or 50 basis points. But this was the wash up from the Friday session. You can see very solid gains. The Dow in particular rallying more than 0.7%, but in lockstep across on the major indices, all pushing forward into the green and topping up on what were very strong levels across the trading week. 4% gain for the likes of the S&P 500. Very strong range there. And if you look at some of the big drivers in session, again, it was technology names, real market leaders over the course of the week. Friday session was Alphabet for the S&P 500, United Health for the likes of the Dow. And you could see where the gains were concentrated across the week, really around those technology names in particular. 6% pop on the Nasdaq, and it was Broadcom moving to the upside for the Nasdaq in that Friday session. Semiconductors again back in play, but also those FANG Plus stocks. And you did see a rally in that area of the market to the tune of 4.5% for the trading week. So a lot of usual names getting back into very strong momentum territory last week. What we saw in treasuries, the decline in yields has been interesting. The 2-year trading around the lowest levels we've seen so far this year, 3.58%. The 10-year we're trading, you can see in the range to 3.65%. So not much of a differential between those two trades. I want to show you the dollar trade. The one that really jumps out has been dollar yen. That's where you've seen a steady decline over the course of September, in particular in dollar versus yen. And this morning we're just perched, holding on to the 140 handle, another 0.5% leg lower. So that's been one of the big moves out there. Also what we're seeing on this very big week for the central bank stateside, euro, sterling, both making gains for the Monday session. So you've got to say just a little bit of tweaking of portfolios heading into that decision that's leaving dollar on the back foot this morning. And you can see just running it up versus the Swissy as well. To WTI, Brent and gold, another weak read in from the Chinese economy in terms of the data that we saw: industrial production, retail sales, fixed asset investment. Not very helpful for some of the commodities trade. And you can see this morning, WTI trying to hold the line, 68.71, slight fade on Brent. We're 71.5 there. Gold prices fairly steady, modestly higher almost in session, 25.85.86 this morning. Asia markets, we actually a lot of markets, a lot not trading today. In particular, you've got Japan out of action today. You've got other major markets shut. China, the Mid-Autumn Festival is also taking place, and to South Korea out of action as well. So we're showing you the Hong Kong market flat today, Nifty 50 out of India, modestly firm along with the TAIEX out of Taiwan, and the Australian market picking up some speed too, Steve.
Super, Karen. Right, let's get to this data. Chinese industrial output growth slowed to its lowest level since March last month. Missing expectations, retail sales also grew less than expected in the month, whilst house prices fell over 5% on the year. And Sam, there's so much to break down there as well, but house prices falling again aggressively, which is a bit of a rebuff to those who say, oh no, we've stabilised, things are getting better on that front and we can build from there as well. Lots to break down. Good morning to you.
Very good morning to you, Steve and Karen. Well, as you say, the new home price is continuing to fall. We're looking at more than a 9-year low now. So the property sector really still struggling to find a bottom here. There are these persistent concerns and problems around trying to soak up some of that inventory. Also, the cash-strapped developers, no doubt the wary banks as well, not to mention the demand that really just is not there at the moment for some of the housing over in China, given some of the consumer concerns and, of course, Chinese people tightening their belts, not going out and spending like they used to. So we continue to see that the stimulus that has been really thrown at the property sector has failed to bring back that confidence. So really more is needed to be done here as far as economists are concerned, because really this continues to be the big drag on the economy. You've seen it in the fixed asset investment too. Property investment still down around 10%. That brings me to the data trio, which you mentioned as well, with the industrial output and the retail sales. Of course, barometers for manufacturing and consumption. Interesting that the industrial production actually came in at a 5-month low, despite the fact that really manufacturing and exports seems to be the one thing that's going for the economy at the moment. So that's something to keep an eye on. But really, the retail sales are struggling to get out of this sort of 2 to 3% range. And so really more is needed to be done to help the consumer and that has sort of revived a lot of these talks in recent weeks about cash vouchers, whether we'll see that, because there doesn't seem to be much appetite as far as President Xi is concerned, because, of course, he thinks that it's really down to welfareism and laziness. So we'll see if that helicopter money does indeed come as part of a stimulus package. But really, the feeling now in the market off the back of what has been a disappointing sort of 72 hours since that Friday the 13th close with all this Chinese data is that we need to see imminent stimulus. What that will look like is the big question. There are very much growing expectations in the market for a triple R cut, and then, of course, subsequently some rate cuts down the road. We are, of course, in a holiday right now, the Mid-Autumn Festival. The mainland Chinese markets are closed today and tomorrow. Probably a good thing, given that we did see really no good news in this data set over the weekend, very much highlighting some of the short-term and long-term challenges that China is facing at the moment. But then all eyes will be very much on the loan prime rate decision, which will be out on Friday, whether there is appetite to cut the 1 and the 5 year. Of course, given that we do have that Fed decision as well, you and Karen, Steve, were talking about that at the top of the show. There is an expectation that that should give the PBOC even more headroom to ease further. So we'll see if that is something that we see on Friday as far as the 1 year, what most new and outstanding loans is based on, and then the 5 year, importantly, which of course is the mortgage reference rate. So whether there is appetite to continue to help housing, as I mentioned, which is a big drag with those new home prices coming in at more than a 9 year low. We also got credit data out from the PBOC. We can't ignore that, because that's telling us a lot about the credit impulse now. New bank lending, that from the households and the corporates, that actually came in better than the 15-year low that we'd seen in July, but still not as far as market expectations are concerned. So as a result, off the back of this set of data, we have seen further downgrades to GDP forecasts from the likes of Goldman Sachs and Citi. They're now looking at about 4.7%. So very much the expectation now is that we do need to see more stimulus to propel that growth to that target that the government is punching for. Back to you guys.
Superb coverage as ever, Sam. Thank you very much indeed for that. Well, we've got Duncan Wrigley with us, Chief China Economist at Pantheon Macroeconomics. Really nice to see you. Look, any industrializing economy has a slowdown. It's just the way it goes. And we've seen the dramatic slowdown from the double-digit figures to mid-single digits, and it appears to be a bit slower than that for the broader Chinese economy. So how much of this, and it's very difficult to disseminate in many ways, is about a natural structural change in the Chinese economy, and how much is it more worrying perhaps for the PBOC and for the Chinese Communist Party about actually there's something else going on here which they can't necessarily control?
Well, there is a massive structural change going on in the Chinese economy. Property sales, they're down 40-50% from pre-COVID levels. You know, during the pandemic, there was an up and a down, but compared with pre-COVID levels, 40-50% down. So that is a big hit to domestic demand. Housing is 70% of people's wealth. So naturally it also affects consumption, sentiment, also rock bottom. So yes, it's a structural adjustment. You could say it's natural, and certainly the Chinese government's promoting manufacturing, industrial upgrading, but it has a long-lasting effect.
So you've made this 3D, because I was talking about the structural effects of any industrialized economy slowing down, and the cyclical effects of China just going through a cycle. You're talking about another structural issue, which could have perhaps been averted more if China hadn't have spent so much time and energy and used so much political and economic capital on building up a housing and real estate market that is now, I think fair to say, I think we can all agree, has crashed. That is very difficult because, again, as I've said time and time again, the Chinese consumer, the Chinese population, they are very smart, they are the best savers on the planet, and they are shaken to the core.
They are very concerned, you know. Housing is still falling this month, that despite some stimulus measures back in May to try and prop things up, haven't yet put a bottom underneath it. So I guess on the positive side, you could say, you know, given the size of this big housing downturn, what China hasn't seen, say compared with many other subprime crises, Japan's big housing downturn, you haven't seen a systemic financial crisis in China, or certainly not globally. So to some extent, the Chinese government has managed to insulate this big adjustment in the housing market from the financial sector and prevent a bigger crisis. So instead they're going through this sort of slow, painful, grinding adjustment.
I think we get the message. It's going to take a while, and we've seen a few sugar hits along the way with these shopping vouchers trying to shore up the consumer. But what about the external forces? Because it feels as though China has used a window. It's been trying to ramp up some of its exports, but now things are getting a little bit tougher as we talk about the headwinds internationally. In the Biden administration Friday pushing ahead with some of those steep tariffs that come into force later on this month, with the 27th of September, 100% duty on Chinese EVs, 50% on solar cells, 25% on steel, aluminium, EV batteries, key minerals also caught up in this. I mean, does this get much harder for China?
I mean, you're right. Currently, China is relying a lot on exports. Exports have held up surprisingly well. I mean, thanks partly because the renminbi was very weak, 6 months, a year ago, and that's all feeding through. So you've got two things. Geopolitics getting more difficult. Europe's put on tariffs on EVs too. And also the renminbi has appreciated in recent months. So all of that is going to pose a headwind to exports, perhaps as soon as the last quarter of this year, but certainly going into next year. And so this raises a question for the Chinese government, which is, frankly, exports have been one of the last engines supporting China's growth, getting it anywhere near the target for this year. If that really starts to give up, going into the rest of the year, into next year, then calls for stimulus will start to pick up more.
We used to always talk about China in the equation that there was no ability to be patient to run any sort of economic woes because there was a big population to keep fairly happy. What does that look like in today's day where you've got a lot of domestic politics in focus for investors? Is there a level of unsettledness creeping through the population with all the property woes that continue to go on and now a growth rate sub 5%?
Well, as far as we can tell, the Chinese government seems to have done a reasonable job in avoiding major unemployment issues. There were worries last year coming out of the pandemic reopening, but the government's created a lot of make work programs, getting graduates to go back to studies or take lower paid jobs they don't really want. There seems to be this sort of sense of resignation amongst many people. They don't have the same expectations and hopes and optimism about the future that they did have 5 years ago, but there isn't quite the same level of crisis that is really spurring people to get out and protest as much.
Duncan, the elephant in the room in terms of one of the other remedies is that their exporting of higher tech, higher value exports is going to be problematic under a Trump presidency and still quite awkward under a Harris presidency as well. How much could either of those actually be a determining factor on how China grows its way out of this?
Well, the US alone accounts for about 15% of China's total exports to the world. It's come down because of some of President Biden's measures already and Trump's before that.
Yeah.
So the US alone, if it imposes very strong measures against China, could have another hit against Chinese exports. But the X factor is whether the US is able to rope in like-minded allies from the West, Europe, Japan, to impose similar measures. And so far, it doesn't look like, for example, Europe is quite as willing to go as far as that.
Yeah, peace looks like it's almost breaking out, doesn't it? Duncan, lovely to see you. Thank you for joining us bright and early on a Monday morning. You obviously had a very good restful weekend. Did you?
Oh, yes, thanks very much. It seems so far away now.
It's only Monday morning. We've got a long way to go, mate. I tell you. Well, Karen and I have still got another 14 hours and 41 minutes of programming to do this week. Thank you. In fact, a little bit more than that. Right, Duncan Wrigley, thank you, Chief China Economist at Pantheon Macroeconomics. A great piece from Evelyn Chang, actually, and Anik Bao on our website. Analysts say Chinese local government finances could take as long as 5 years to recover to a healthy state after being hit by recent macro concerns, but mostly the property market weakness. Their revenues have been sived on that front. Great piece. It's on CNBC.com. You can look at it while you're looking at this show if you can do two things at once. If not, do it afterwards. The FBI is investigating what it is describing as an apparent assassination attempt on the life of the former President Donald Trump. This after a Secret Service agent spotted a man with a scoped rifle in the bushes next to his golf course of his Mar-A-Lago home, leading to shots being fired. Now, one person is in custody after the incident. It comes just 2 months after Mr. Trump was hit in the ear by a gunman at a rally in Pennsylvania. President Biden and the Democratic nominee Kamala Harris have both put out statements condemning political violence this morning as America marks 50 days until voters go to the polls. Well, NBC News' Alice Barr filed this report.
For the second time in 9 weeks, the FBI is investigating what it's calling an apparent assassination attempt against former President Trump. The former president was not hurt in the incident near where he was golfing at his course in West Palm Beach, Florida. One man is in custody. 3 senior law enforcement officials briefed on the matter tell NBC News that man is 58-year-old Ryan Wesley Ruth. This comes after authorities say a Secret Service agent spotted and fired at a suspect just outside the golf course fence line while the former president was golfing 300 to 500 yards away.
What they do is they have an agent that jumps one hole ahead of time to where the president was at. And he was able to spot this rifle barrel sticking out of the fence and immediately engage that individual, at which time the individual took off.
A witness reported seeing someone run out of the bushes and into a black Nissan and snapped a photo. Sheriff's deputies then tracked the license plate and quickly stopped this black Nissan, taking the suspect into custody.
In the bushes where this guy was is a AK-47 style rifle with a scope, 2 backpacks which were hung on the fence that had ceramic tile in them, and a GoPro.
The incident raising new questions about securing the former president and Republican nominee. The Secret Service faced sharp criticism after former President Trump survived an attempted assassination at a Pennsylvania rally in July. The former president saying he is safe and well and will never surrender. Vice President Harris saying she had been briefed on the situation, was glad he is safe and, quote, violence has no place in America. In Washington, Alice Barr, NBC News.
Coming up on the show, India's central bank governor tells CNBC the country can achieve sustainable growth of up to 8% in the coming years. We'll bring you that exclusive interview. Plus, German government and Bundesbank officials are weighing in on UniCredit upping its stake in the country's number 2 lender, Commerzbank. We'll discuss. And we'll be getting half-yearly results out of UK pensions manager Phoenix Group. And we'll be hearing from the CEO, Andrew Briggs. That exclusive interview is coming up at 8:15 CET.
India's central bank will not be influenced by how much the Fed cuts rates at this week's meeting. This, according to the RBI Governor Das, in an exclusive interview with CNBC. Well, as you can see, Tanvir conducted that excellent interview and joins us now. Tanvir.
Very good morning to you, your side, Steve and Karen, and thanks very much for having me on the show. Yes, indeed, it was, firstly, the RBI governor rarely speaks. So when he does, the market does listen. Investors do sit up and take note. And so it was a fairly expansive interview that I had with him on Friday when he was visiting Singapore, talking about rate cuts, talking about inflation outlook, growth outlook, talking about the currency movement. Just to remind all your viewers in Europe that the Indian rupee has been the least volatile currency in major emerging markets. For the year thus far, it's just lost about 1%. And then, of course, also wanted to talk to him about the health of the banking sector, because Indian banks, according to a JP Morgan report, have one of the best balance sheets in the APAC region. When I quizzed him about Fed policy and the expectation of rate cuts, 50 or 25 basis points, he said, internally speaking, for the Indian policymaker, it does not have much of a bearing. In fact, they believe that they are driven more by the domestic fundamentals on inflation and growth. Inflation is well within the RBI's comfort zone. And on growth, they're looking pretty stable. They've kept their overall year FY25 year's growth target unchanged at 7.2% at a time when the World Bank has upgraded the growth number to 7%, even though Q1 growth came in slower at 6.7%. When I asked him about whether there was any downside risk to growth in their projections, he categorically said no. But this is interesting about how he's looking at the rate decision going forward, given that they have their first Monetary Policy Committee meeting coming up in the first week of October, just after the Fed would have already cut rates. So this is what he told me on that matter.
We have maintained status quo in our rate cycle so far. After our rates, we increased it up to 6.5. After that, for the last 2 years or so, we have maintained status quo with regard to the rates and with regard to the monetary policy stance. The latest inflation print for August has come out yesterday. So next monetary policy meeting will be held in first week of October. So the Monetary Policy Committee will take a decision. But having said that, let me say that, we have to really see how the outlook is. It's not a question of that in the, in the current context, in the, like in July, the inflation came to about 3.6. That is the revised number now. Yeah, 3.6. And August has come at 3.7. So it's not so much how the inflation is now. We have to look at for the next 6 months, for the next 1 year, what is the outlook on inflation. So therefore, I would like to sort of step back and look at more carefully what is the future trajectory of inflation and growth, and based on that we will take a decision.
And we'll talk about inflation outlook and growth outlook for the long term, but I do want to understand from you, as we speak, is the MPC at the RBI actively considering a rate cut, and will that happen in the October meeting?
No, I can't say that. First, in October we have a new MPC, in the sense that the external members will be new, because the current external members, their tenure, 4 years tenure has ended. So there will be new members, external members, 3 members who will be inducted into the MPC. So we will discuss and decide in the MPC. But so far as growth inflation dynamics is concerned, 2 things I would like to say. One, the growth momentum continues to be good. India's growth story is intact. And so far as the inflation outlook is concerned, we have to look at the momentum, the month-on-month momentum, and what is the momentum of inflation, build up or moderation, either way. So what is the momentum of inflation trajectory in the coming months? So the outlook we have to look at. It has to be a forward-looking approach. So based on that, we will take a decision.
I think Stephen Karen, if you read between the lines, he's generally sending out a message that the RBI is not in a hurry to cut rates, that the October meeting would not be live. In fact, even the markets, if you look at most economists and analysts tracking the rate trajectory in India, are saying that only post-December could the RBI seriously consider bringing down rates. As of now, the festive period would help boost consumption, boost growth, which will be running through the months of October to December. So that's fine. And inflation, on the food inflation side, things are looking a bit risky because, vegetable prices in India are going up. So I think they want to monitor that situation. Durability is the key word over here in terms of keeping a lid on inflation and the overall inflation trajectory, the print out there. So I think from that standpoint, the RBI would be driven by domestic fundamentals than what the Fed does. And also, they never offer forward guidance. So it's really a bit of a guessing game, really, for the markets on when they would blink on rates and start the easing cycle. Back to you guys.
Yeah, great work. I mean, it's extraordinary, isn't it? You've got thank you very much for that, Tanvi. You've got a 7.2 expected growth rate this year. I think that was Fitch. And you've kept rates unchanged at 6.5% since February last year as well. It's an enviable position. Of course, a lot of Southeast Asian neighbours and across Asia Pacific more generally would just be desperate for those kind of numbers.
Well, we used to talk about this neck and neck race between China and India, which growth rate was going to be stronger for the long term. Right. And here we have China barely growing now at the rates that it's set out to achieve itself.
Actually, and you made a really good point earlier on with the Duncan Wrigley interview about population changes as well. Well, demographic changes have meant that the population, I think it was 2023, where they were neck and neck, and now India's got a hugely growing population, or a growing population, whereas the Chinese have a declining population. The Chinese aren't the only ones, but it's, obviously the one-child policy has exacerbated that.
Thank you for listening to Squawk Box Europe Express.
For more market-moving news, you can head to CNBC.com.
Or join us again on the show with Steve Sedgwick, Karen Cho, and myself, Arabi Lekumete, weekdays on CNBC.